Beneath California's golden skies and whispering palm trees, a silent storm is brewing. The paradise that once promised ocean views and suburban serenity is now teetering on the edge of a housing collapse. In 2025, cities that once symbolized success, where homes soared past $2 million and sold in days, are unraveling under the weight of sky-high mortgages, vanishing demand, and financial overreach. From the cliffside villas of Dana Point to the tech-powered towers of Irvine, cracks are forming in the dream. This isn't just a slowdown, it's a reckoning. These are the 10 California cities you must avoid before the bubble bursts. Number 10. Fountain Valley. Fountain Valley might have once flown under the radar, but in 2025, it's front and center on the list of California cities where the housing market feels dangerously overheated. Located in the heart of Orange County, this suburban community has seen massive appreciation over the past decade, with home values climbing over 75% since 2015. In 2023, the median home price hovered around $1.1 million, but by early 2025, it surged past $1.37 million. For a modest 3-bedroom, 2-bath single-family home, you're now looking at monthly mortgage payments of over $8,200, assuming a 7% interest rate and 20% down. Yet despite these high prices, wage growth in the area hasn't kept up. The median household income in Fountain Valley sits just under $110,000. That means even well-paid families are dedicating over 70% of their gross income toward housing if they buy at today's prices. Financial planners typically recommend spending no more than 30%. That's a serious affordability red flag. Add in property taxes at about 1.1% annually, or roughly $15,000 a year, on a $1.37 million home, plus home insurance, which can exceed $180 a month. $3,500 per year due to increased fire and flood risks. And the total cost of ownership balloons fast. Inventory has also been rising in 2025, with average days on market now exceeding 50 days compared to 21 days in early 2022. Price reductions are becoming common, and many sellers are forced to chop $50,000 to $100,000 off their original list prices to stay competitive. At the same time, new listings in the area are up 30% year over year, signaling softening demand amid soaring costs. With rent prices also flattening, currently averaging $3,200 per month for a 2-bedroom apartment, many investors are questioning the long-term return potential here. If interest rates remain elevated and demand continues to cool, Fountain Valley's housing bubble could deflate hard. Number 9. Tustin. Tustin, nestled in central Orange County, might seem like a suburban dream. Tree-lined streets, charming neighborhoods, and a prime location near Irvine and Santa Ana. But in 2025, this dream comes at a staggering cost. The median home price in Tustin has surged to approximately $1.21 million, up from $920,000 just 3 years ago. That's a jump of over 30%, fueled by tight inventory and aggressive investor demand during the pandemic years. But now, cracks are forming. With mortgage rates averaging around 7%, a 30-year fixed loan on a median-priced home with 20% down now runs over $7,400 per month. That's before taxes and insurance. The median household income in Tustin hovers around $100,000, which is simply not enough to comfortably manage these payments. Housing affordability in the city has collapsed, with price-to-income ratios nearing 12 to 1, far above the national average of 4.5 to 1. Property taxes alone, at roughly 1.1%, add another $13,000 annually, while fire insurance in California continues to climb past $2,500 per year in many Orange County communities. On the supply side, the inventory of homes in Tustin has been climbing steadily in 2025. Listings are up over 25% year over year, and homes are sitting longer, now averaging 47 days on the market compared to just 18 days in early 2022. Over 40% of current listings have had at least one price cut, often between $25,000 and $75,000, a sign that demand is softening rapidly. Even the rental market, once red hot, is showing signs of fatigue. Average monthly rents for a 2-bedroom apartment have plateaued around $3,100, making real estate investors think twice about cash flow. With borrowing costs high, affordability stretched thin, and fewer buyers entering the market, Tustin's housing market appears extremely vulnerable. Without a significant correction or a drop in interest rates, this city may face a painful period of stagnation, or worse, depreciation, in the coming year. Number 8. Villa Park. Villa Park is one of the smallest and wealthiest cities in Orange County, often dubbed the Hidden Jewel. But in 2025, this jewel might be losing some of its shine. With just under 6,000 residents and minimal new housing construction, Villa Park has long maintained sky-high real estate values due to its exclusivity and low turnover. However, as of 2025, the median home price in Villa Park has ballooned to approximately $2.34 million, up nearly 40% since 2020. For a typical buyer, affording a home here is a massive challenge. Assuming a 20% down payment and a 7% mortgage rate, the monthly payment for a median-priced home in Villa Park exceeds $14,200 before taxes and insurance. Property taxes, at 1.1%, add another $25,700 per year, and homeowners' insurance in the high-value bracket can easily run north of $5,000 annually. Combined, buyers are looking at nearly $200,000 in annual costs just to maintain their home. Despite the city's prestige, even wealthy buyers are starting to balk. Listings in Villa Park are sitting longer, currently averaging 60-plus days on the market, up from just 21 in late 2021. Many homes have seen price cuts of $100,000 or more to attract attention, and while inventory remains low, demand has softened. Some local agents report that high-end homes are selling at discounts of 5% to 10% off asking. The problem isn't just pricing, it's liquidity. When homes are priced in the $2 million to $5 million range, the buyer pool shrinks dramatically, especially when interest rates are high and the cost of capital is tight. Add in shifting economic conditions and wealth preservation strategies, and many high-net-worth individuals are moving their funds elsewhere, stocks, bonds, or out-of-state investments. In short, Villa Park might still be a status symbol, but its ultra-high valuations are looking increasingly fragile in a post-pandemic, high-interest rate world. Unless mortgage rates plunge or a new wave of buyers floods in, Villa Park's luxury bubble may be headed for a slow, quiet deflation. Number 7. Cotto Decaza. Cotto Decaza is the epitome of exclusive Orange County living, a gated master-planned community with rolling hills, equestrian trails, and multi-million-dollar homes. But in 2025, this luxury enclave is starting to show signs of market strain. The median home price here now sits at an eye-popping $2.05 million, having climbed more than 35% over the past 5 years. And those prices come with very real monthly consequences. A buyer putting down 20% and financing at today's 7% mortgage rate is looking at monthly payments of approximately $12,400 before taxes, HOA dues, and insurance. Property taxes tack on an extra $22,500 per year, while fire insurance premiums in this rural adjacent area can easily surpass $4,000 annually. Then there are HOA fees, commonly around $500 per month in Cotto, which adds another $6,000 annually. Altogether, the cost to simply exist in a typical Cotto home exceeds $200,000 per year for many households. Even with the community's prestige, buyers are hesitating. Homes now spend over 55 days on the market, double the average seen during the 2020-2022 boom. Inventory has ticked up by more than 20% year over year, and price reductions are commonplace, often in the six-figure range. Agents report an increasing number of sellers trying to offload before prices dip further, especially those with adjustable-rate mortgages resetting to painful levels. The buyer pool for homes priced above $2 million is narrowing fast in 2025. Many former buyers are now priced out or waiting for rate relief. Others are looking to more affordable states like Texas, Arizona, or Tennessee, where similar properties cost half as much with far lower tax burdens. Cotto Decaza may still boast country clubs, horse stables, and breathtaking scenery, but the economics are no longer lining up. Unless interest rates drop or incomes surge, this community is perched on the edge of an unsustainable pricing cliff. Number 6. La Cañada Flintridge. La Cañada Flintridge is synonymous with elite Southern California living, nestled against the foothills of the San Gabriel Mountains, and known for its serene neighborhoods, low crime, and affluence. But in 2025, this exclusivity comes at a staggering cost. The median home price in La Cañada has exploded to around $2.5 million, making it one of the priciest zip codes in the state. That means a 20% down payment alone is $500,000, and a 7% mortgage on the remaining $2 million balance equates to over $13,300 per month, before factoring in taxes, insurance, or maintenance. Annual property taxes run roughly $27,500, and homeowners' insurance premiums often exceed $5,000 given the hillside wildfire risk. The total cost of owning a standard home here approaches $210,000 per year. And with inflation and economic uncertainty hovering over the housing market, even high net worth buyers are showing restraint. Inventory is rising, and listings are sitting longer, averaging 58 days on the market, up from just 19 during the pandemic boom. More than 35% of active listings have been reduced in price, many by $150,000 or more. Adding to the concern is the extremely high price-to-income ratio. While many residents are professionals and executives, the average household income around $200,000 still falls short of what's needed to comfortably manage these costs without relying on massive leverage or wealth. Buyers are growing wary of locking into homes that may lose 10% or more of their value in a market correction. What's more, La Cañada is heavily reliant on the luxury segment, meaning demand is far more sensitive to changes in interest rates and stock market performance. With fewer international buyers and more cautious investment behavior in 2025, the pool of qualified buyers has shrunk significantly. Unless interest rates fall back below 5% or liquidity floods back into the luxury real estate sector, La Cañada Flintridge may find its sky-high valuations difficult to sustain and ripe for recalibration in the near future. Number 5. North Tustin. North Tustin is an unincorporated, affluent enclave tucked within central Orange County. Known for its sprawling lots, hillside estates, and quiet residential charm, it's long been a magnet for families seeking luxury without the city bustle. But in 2025, the housing market here is pushing dangerously close to bubble territory. The median home price has soared to around $1.79 million, up from roughly $1.2 million in just 5 years. This 49% appreciation far outpaces local income growth, and it's raising eyebrows among analysts and buyers alike. A 20% down payment on a home here is around $358,000, with monthly payments on a 7% mortgage running over $11,900. Add in $19,600 in annual property taxes and around $4,000 in homeowners insurance, and you're looking at a yearly housing burden near $170,000, not including maintenance and utilities for large properties. That's a steep price, even for high-earning families with six-figure incomes. Inventory has been climbing steadily, up 25% year over year. Homes that once sold in under 3 weeks are now sitting on the market for 50 to 65 days. Many listings have undergone price reductions of $75,000 to $150,000, especially in the $2 million plus category. The trend is no longer an outlier. It's becoming the new normal. What's especially worrying is that North Tustin lacks the walkability, business centers, or entertainment hubs that typically support such high valuations. Its appeal is largely suburban, great for privacy, but hard to justify if home values begin declining. With high mortgage rates and slowing demand, more buyers are simply priced out or unwilling to overextend. Investors, too, are starting to retreat. Rental yields have dropped, and a $6,000 monthly rent on a $1.79 million home just doesn't pencil out. As borrowing costs rise and inventory continues to build, North Tustin may face a slow but persistent erosion in home values, making it one of the riskier high-end markets in Orange County. Number 4. Dana Point. Dana Point is a postcard-worthy coastal paradise, perched on dramatic cliffs with ocean views, yacht harbors, and some of the most beautiful shorelines in Southern California. But for all its natural charm, Dana Point's housing market in 2025 is treading into bubble territory. The median home price has surged to a lofty $1.7 million, pricing out even many upper-middle-class families. That translates to a monthly mortgage of approximately $11,300 with a 7% interest rate and 20% down, excluding taxes and insurance. Once you add the $18,700 in annual property taxes and around $4,500 for insurance, thanks to its coastal location and fire risks, the cost to own a median home in Dana Point exceeds $160,000 per year. And this doesn't include HOA fees, which often run $350 to $700 per month for ocean view condos or gated communities. In total, some homeowners are paying over $180,000 per year just to maintain their lifestyle. Despite all this, sales activity is softening. Days on market have increased to over 60, a dramatic shift from the pandemic frenzy when homes were snatched up in days. Over 45% of listings have experienced price cuts, many slashed by $100,000 or more. The high-end market is cooling, and investors are hesitating as rental income no longer offsets the costs. Oceanfront properties might still command top dollar, but the rest of the market is feeling the pressure. The local economy also plays a role. Dana Point relies heavily on tourism and hospitality, which can be volatile in economic downturns. Many short-term rental owners are now trying to exit, flooding the market with inventory. Combine that with fewer international buyers and tighter lending standards, and you have the makings of a localized housing correction. While Dana Point will always be beautiful, in 2025, it's becoming financially out of reach for the vast majority. Unless interest rates drop sharply or income growth surges, many buyers may be priced out, and current owners could see values plateau or even dip. Number 3. Aliso Viejo. Aliso Viejo is a modern master-planned community tucked in southern Orange County, celebrated for its clean streets, family-friendly neighborhoods, and proximity to both beach and canyon. But in 2025, this once accessible suburb is grappling with some of the worst affordability metrics in California. The median home price has surged to around $1.02 million, up nearly 35% since 2020. For a buyer today, that means a 20% down payment of $204,000 and a mortgage of about $6,800 per month at 7% interest, not including taxes or insurance. Annual property taxes in Aliso Viejo run roughly $11,200, and insurance can tack on another $2,500 or more per year. That brings total yearly housing costs to over $96,000, nearly equal to the city's median household income, which hovers around $105,000. That's a major red flag for long-term sustainability. Most financial experts recommend housing costs not exceed 30% of income, but in Aliso Viejo, it's nearly 90% for median earners looking to buy today. Housing inventory is also growing. Homes are sitting for an average of 52 days on the market, compared to just 17 days in 2021, and more than 40% of active listings have had price reductions. The high costs are choking demand, and sellers are beginning to panic, offering concessions and trimming listing prices by $50,000 or more. The rental market is no better for investors. A typical two-bedroom apartment rents for about $3,000 a month, which doesn't cover the cost of owning for most new buyers. Cash flow is thin, and many landlords are bailing out, especially those holding variable-rate loans that have reset with higher interest rates. With high costs, softening demand, and income levels unable to keep pace, Aliso Viejo is walking a tightrope. Unless mortgage rates fall significantly or wages spike, prices here are more likely to decline than continue rising. In the meantime, would-be buyers are sitting on the sidelines, waiting for what feels like an inevitable correction in this overextended housing market. Number 2. San Clemente. San Clemente, dubbed the Spanish Village by the Sea, is a coastal gem in South Orange County known for its red tile roofs, surf culture, and panoramic Pacific views. But in 2025, this sun-soaked paradise is sitting on a real estate bubble that's nearing a breaking point. Median home prices have climbed to a staggering $1.72 million, up over 45% since 2019, placing it among the most expensive non-metropolitan coastal markets in California. For today's buyer, that price point demands a down payment of nearly $344,000, and monthly mortgage payments top $11,500 at a 7% interest rate. Add in $18,900 annually in property taxes and roughly $4,500 for insurance, especially crucial in a region increasingly exposed to sea level rise and coastal erosion, and you're paying close to $180,000 a year just to own a median home. But price alone isn't the issue. San Clemente's market is seeing demand slow dramatically. Average days on market have climbed past 63, and sellers are now routinely slashing asking prices by $100,000 to $200,000. In early 2025, nearly half of all listings underwent at least one price cut. Inventory is rising, particularly in the luxury condo and second home markets, where out-of-state buyers are disappearing due to high borrowing costs. Worse yet, the rental market is cooling as well. Investors who scooped up properties during the pandemic frenzy are discovering that even at $4,000 to $4,500 in monthly rent, they're falling short of covering mortgage payments, HOA fees, and property upkeep. With short-term rental regulations tightening, many vacation rental owners are also jumping ship. San Clemente is facing a triple threat: unaffordable purchase prices, declining investor returns, and increasing climate risk. While the scenery remains unbeatable, the housing economics no longer add up. If interest rates stay high and buyer hesitancy continues, San Clemente may become a case study in what happens when a coastal boomtown gets priced beyond its fundamentals. Number 1. Irvine. Irvine, long hailed as a safe, clean, and master-planned model city, has transformed into one of California's most inflated housing markets in 2025. With a median home price now reaching a jaw-dropping $1.62 million, the dream of homeownership in Irvine has become virtually unreachable for average Californians. That price represents a nearly 40% increase since 2019, despite recent signs of buyer fatigue and softening demand. A typical buyer today faces a monthly mortgage payment of over $10,800 after putting 20% down, $324,000. Property taxes on a home of that value total around $17,800 per year, and homeowners insurance adds another $3,500, more in certain fire risk zones. That's nearly $150,000 in annual housing costs for a median-priced home. Compare that to Irvine's median household income, which is around $120,000, and you get a price-to-income ratio of over 13-to-1, an unsustainable level by any historical standard. Inventory is on the rise in 2025, with listings up 35% year over year. Homes that once sold within 10 days are now sitting for more than 55, and nearly half of Irvine's active listings have undergone price reductions, some slashed by $150,000 or more. The high-end condo market is especially weak, with foreign investor demand shrinking due to capital controls and global economic uncertainty. Irvine's rental market is also experiencing turbulence. While a two-bedroom apartment still commands over $3,400 a month, that's not enough to justify the sky-high purchase prices for investors relying on rental income. Many landlords who bought during the market's peak are now seeing negative cash flow, particularly those using adjustable-rate mortgages. With high prices, falling affordability, weakening demand, and rising inventory, Irvine is a textbook example of a housing market that has outpaced economic fundamentals. Unless mortgage rates plummet or tech sector hiring surges again, the city may see a correction not in reputation, but in real estate values.